Good morning, everyone. Today is October 1st. Yes, we've rolled over into October 1st. It's early in the morning. I'm trying to do a quick little update to get you guys prepared for what's likely coming. First, we are going to highlight the activity that normally takes place in the third quarter and the fourth quarter of every year. This is my data mining tool that I can use to go back and track the performance over any given day, month, year. And what we're looking at right now is the analysis for the third quarter, which historically over 25 bars has been moderately bearish. You can see we've got a minus 1200 average to a plus 1200 average. We've got 10 bars making up the negative average to 15 bars making up the positive average. And the negative average is about 1.5 to 1 compared to the positive average. You can see here generally, ladies and gentlemen, that third quarters are pretty rough on an average. We've got essentially a negative bias going into a third quarter. It's very difficult to have any real strength in the third quarter. Typically, it's an unwinding phase. And it's been moderately difficult. You can see 10 of the last 25 years have been negative, and it's been on average about a minus 124 points. This is on the ES, and then 15 bars have been positive, and it's been positive about 81. So the upside ratio is about 2/3 of the downside potential going back over the last 25 years. Now, the fourth quarter is vastly different. The fourth quarter is 20 bars positive, averaging 146 points to the upside, totaling 2,900 points roughly right here. The negative is 5 bars average to the downside, showing a negative 176, let's call it 177, totaling 884, minus 884. The positive to negative upside to downside ratio is about 40 or 50 points positive, compared to this side here is about 60, 70 points positive on the third quarter. But the bias of the third quarter is strongly more neutral to the downside, as you can see here. This is strongly bullish to the upside. Fourth quarters are generally very, very strong. And that's one of the reasons why we have the Christmas rally, and it's another reason why we have more data moving into the first quarter of the next year, carrying over from this strength. So generally, fourth quarter and first quarter of the following year are normally fairly strong. So now, as we take a look at the chart, what I wanted to try to highlight is that we are seeing some moderate support around these blue line here and this green line here. This originates off the highs from the 2002-3 level, the rally back after the original dot-com bubble burst. And then we do the same thing across the highs here, 2010 to 2014, and we move them across. And we have some moderate support right where price is right now. Okay, so we're looking at the potential that we could see some sort of moderate support in this area. You follow these lines. These are the lines right here. This line here and this line down here. That puts us at moderate support anywhere over the next quarter, somewhere between 3,400 on the ES and 3,584 on the ES. I'm just pointing, and this would be my green level right here. This green level right here is a key element of support right now. Let me try to expand this a little bit. There we go. So this, ladies and gentlemen, would be an element of support that lies in the market right in this area, right where we were at last week. Now, ultimately, everyone has been talking about what happens if the market breaks below these levels. Well, let me give you an A and B scenario. The U.S. market has stayed relatively immune from global crisis, and I'm going to show you exactly what's going on. The technology sector and other sectors have really unwound quite a bit. but the large caps and the S&P are holding up okay compared to what's going on through the rest of the world. And the reason this is taking place is because, as I had mentioned many years ago and last year, that I expected the U.S. markets would stay somewhat relatively immune to what's going on in the world as the global market excess debt credit phase unwound when the Fed finally transitioned into moving rates higher. So what we're seeing right now is really a global unwinding of excess credit and debt, which is taking place, whereas the U.S. market has stayed relatively immune from this somewhat. We've had technology blow downward considerably. We've had others, the innovation firms, marijuana sector, other sectors have blown down really hard in the U.S., but that's an unwinding, again, of excesses. And what we're looking at here is, in reality, we've had this blow-off phase, we've had this pullback phase, and if we take a look at let's see if I can get this set up. If we take a look at the opportunities off of this low, so we'll come down to this low and we'll try to pick through various midpoint channels, approximately like this. We have a moderate upward bias still holding in place related to the actual trend that has established over the past 16, 18 years. That's this purple level. And you can see again that this moves right in line with the support channels that we've had going forward around this green area right here. So this gives us an opportunity, 34.84 to 35.83, let's call it, 35.80, a little lower actually, 35.71. This gives us an idea that we may establish very strong support in this channel historically across price highs, price lows, and price medians right in this area right here. And then we may start to see a Q4 rally up and carrying over into a Q1 rally into next year. I would not be surprised to see a shift in the market, a shift in the Fed, possibly still raising interest rates, but maybe only a quarter, maybe only a half, maybe a pause to see how things are taking place. I read an article that the Fed is fearful of a Lehman moment, but I believe they're more fearful of a global crisis event than a U.S. crisis event. So now understand that where we're at right now still is longer term with my modeling systems bullish, short term bearish. We need to see how this plays out. And yes, if we do get below these support channels, then we're going to see probably a bigger downside move, possibly down here to these COVID lows. And that would be a 61.8% retracement off of the long-term channel from the 2009 lows to the recent highs up here. We would be targeting this 382 level at 32.45 or 27.62, this one here, which is the 50% level, or this 22.80. But right now we have this intermediate support that a lot of people are ignoring right in this area, and this plays a very important role for what we're trying to do going forward. I want you to realize that this current support level is likely to still hold. We could see some lower prices. I'll go back to a weekly chart here so you can see. We could see some lower prices here, but remember, these channels, these lines that I've been drawing, they are very important levels going forward. So we have the, let me make sure, that's the green level coming up. Here's the purple level. Here's the other green level off of the, I believe, the 2009 lows, and here's the blue level off of the 2003 lows. So understand that we're right at these levels right now. This is the green level going all the way back. I may not have enough bars to go all the way back to those lows. But you can see this one is carrying across these highs here. This is the one from 2003. This is the one from 2009. The green level where we're at right now, we are right at that 2009 support channel right there. So that's going to act as very moderate support. Could become very critical right now that this green level acts as long-term support. Even though we've blown down here and it looks like we're breaking the new lows, I want you to understand that we've got very long-term 15-year historical support at these levels, and we've got historical 15-plus year median price support right at 3504. So pay attention. We could see a bit of a washout move, freaking everybody out, and then find some real support. Now, let's take a look at a couple of things here that I want you to be aware of. So this is my custom U.S. trend valuation index. And even though the markets broke downward, this one has still holding up above these levels. And these levels go all the way back to the 2013, 14, 15 highs. I mean, this is showing us that we've unwound literally since back over here. We've unwound into a period here that is moderate support, that's acting as moderate support right now. We do not have a breakdown in trend. So price could be reacting a bit more aggressively on the ES, SPY, NQ, and others than the underlying factors in the market. Additionally, we have the large cap index is holding up as well. The US large cap index, these are monthly, is holding up quite well, is not really seeing any big breakdown in trend. And you can see we saw some pretty solid breakdown here and here in a depreciation cycle. We've already seen a fairly moderate breakdown since these highs back in July, October 2021. But the long and short of it is we're not seeing that aggressive selling take place right here. Next, the U.S. to global index. The global index is the red line here, which is the global markets. Think of that as Europe, Hong Kong, China, Asia, and others, have really broken down considerably. Where they're back down near the COVID lows, where we are dancing around just above the COVID highs. And this is the area that I've been highlighting for many months. I mean, going over possibly 6, 7, 8 years, or not 6, 7, 8 years, 6, 7, 8 months. Long and short of it, the U.S. market since 2017 is still up 44%, whereas the global market since 2017 have erased. They're now negative. And we could see the global markets continue to deflate depending on what the Fed does and what the markets do, while the U.S. market stays relatively immune. My opinion is these COVID high levels back over here, or actually just a little bit below these levels, kind of down in this area, could act as very strong support for the markets, the U.S. markets going forward. Next, we have the Global Asset Index. The Global Asset Index is a measurement of valuation levels across not only the U.S., but the global markets. And what we're seeing here is a decidedly depreciation phase that's taken place since the post-COVID level. Things have really begun to devalue. This is off of the cost factors for commodities, energy, and others. We've seen this devalue over periods of time, but we're still holding above these lows. If we continue to hold above these lows, and remember, this is a monthly chart, so this is September right here. If we still hold above these levels and get some sort of a pivot globally, or we move into a fourth quarter upward channel, we could see this begin to elevate back to the upside, showing that the fear of a depreciation phase, an extended depreciation phase, could be abating. This could be just a broad contraction fear level right now off of the Fed move a week or so ago, but we're not seeing any real follow through. Next, I'll skip this one. We have gold. I want to come over here to the Consumer Engagement Index. Consumer Engagement Index is starting to move back upward. And I want to highlight how the Consumer Engagement Index bottoms out during periods of time and then begins to accelerate as consumers re-engage with the market. This has happened over and over again. Bottoms out, re-engages. bottoms out, re-engages. Bottoms out, re-engages. Now, in my opinion, we've got to see a clear close above this purple line to see that we're getting some real momentum. But over the past 3 months, this is again a monthly chart, we are seeing some very strong consumer engagement in the U.S., which is telling us that consumers are not as fearful. Yes, they're slowing down the big ticket purchases. Yes, they're being a little more cautious on homes, cars, and travel. But they are still re-engaging with the market, buying what they need to. They're still working. The U.S. market is different than the global markets right now. And lastly, I want to point out the technology sector. You would think that in a world where the markets are going to collapse and the world is going to potentially end, like these doom and gloomers are talking about, that the technology sector would be one of the first sectors to really unwind and continue to show weakness. But what's happened is we've already unwound all the way back down to 2013-14 levels here. We don't have much further to go before we're back down into 2010, 11, 12 levels back over here. And we've actually flattened out over the last 5 months. So we've seen this broad unwinding in the technology sector. We're back down to 2013, 14, 15 lows, which is where I had originally estimated we would get to, and we are just flattening out. What happens when we're flattening out like this is we will likely start to see some accumulation in the markets, in the technology sector, particularly if we see some sort of a shift in consumer or central bank sentiment going into fourth quarter. If global central banks move towards a little bit more easing, or the Fed pauses a bit or weakens their aggressive stance, we could see this really begin to accelerate, possibly moving back up to 50% of this move. And that would equate to about a 20 to 25% rally in the NASDAQ, which would be substantial. Lastly, I want to point out this accumulation. So when we start looking at volume, and let me go ahead and get more data back out here so we can see, we are starting to get some real accumulation. See how this bottoming cycle took place? Then we started to get into an accumulation cycle back over here with COVID. We had very big volume back over here, a lot of people in here trying to buy the dip. Well, I think we're seeing the same thing take place right here. Last week we had very high volume. I think we're seeing a lot of traders understand the metrics of what's actually taking place right now and attempting to buy the dip. Okay, so we are looking at a very strong metric for a potential buying the dip right around this support level. I believe traders are really understanding the potential of the Q4 rally phase here, the potential that the Fed is cautious of a Lehman type moment and may start to weaken. And I believe we could see a fairly strong recovery back into this apex level, which would put us into November, December of 2022, and that may carry us into a moderate rally into Q1 2023. So if you pay attention to the volume that's taken place at these levels, you're seeing very strong volume at these levels, a little bit of a gap down around these levels, which is why the support level, this green level, is so important for us right now. But long and short of it, ladies and gentlemen, we are, go to monthly, we are looking at a very interesting scope in the market. We are seeing very strong support down near these lows. You can see the volume here with the gap in volume back around this area. This is an area where we can either break below this level, and again, my breakdown level would be around 3380, 3360, and that would have broken these three critical support levels, the trend lines that I'd drawn, plus this green level, and that would put us right back into these COVID high levels. But ultimately, I think these areas are going to hold. I think you're going to see a turnaround. I think earnings are going to come out moderately strong. It's going to change the sentiment, which is essentially that the U.S. markets are still performing, they're still executing, and they are still they're still capable of performing at a more elevated level than people are giving us credit for. Now, what the Fed does, we'll have to see. What metals do, we'll have to see. What the dollar does, we'll have to see. If the Fed pivots to a more moderate QE type of stance, then we could see a big shift in the US dollar and in gold and in the markets. We could see everything kind of shift back into a moderate phase because the Fed has unwound quite a bit of excesses out of the economy. They could pause through the fourth quarter, making adjustments near the end of the year or into Q1 2023. And that would be my likely guess given the extent of the rate increases over the past 4 months or so. So be aware that even though everybody is warning of this potential crash, the markets breakdown, I'm seeing this as quite a different story, moving back into this Q4. In fact, let me real quickly come over here and actually here and go back to quarterly. And let's go to this and see what happens on. So Q1 typically is generally positive. So 17 of the last 25 bars, so of the 17 Q1s over the last 25 years have been generally positive. The negatives outweigh the positives by about a 2-to-1 ratio, but they've only happened about 8 bars versus 17. So this is again a 2-to-1 ratio, positive versus negative. The Q1 sum is 25 or 28.54, moderately positive, but can have some disruptions, is what this is telling us. So Q1 could continue to move into a positive nature, but Q1 could also be slightly to the downside. Let's call it a third of the time, you could see a downside move, which could be fairly aggressive. The Q4 is moderately positive, very strong to the upside, very solid upside potential here. Q1 is a little bit more mixed. So if we get into Q1, we got to be cautious of a potential sideways downward move. And the way that would look, ladies and gentlemen, would be somewhat similar to what I've drawn here. This is quarterly. So let me get rid of this and highlight the fact that we could see a recovery here from this level up, somewhere up into this green area. And then we could see some rotation, Q1, Q3, Q1, Q2. So if I go back to monthly, this is where we're at. And what that shows us is we could see a bit of a move to the upside like this over the next 3 months, possibly back up to this green level near the end of the year, which is actually right over here, and then possibly wallowing around a little bit over here. So be aware, we have a pretty strong potential for an upside move still. We need to see how it plays out. Try not to keep this super long, but I want you to understand that the dynamics of the market, particularly this technology index and the consumer engagement index, as well as the global asset movement, are just telling us that we're not seeing very strong selling. We're not seeing extended selling pressure. Consumers are re-engaging, and technology is already based and bottomed. If we see a recovery phase in Q4, it could be a big surprise to everybody. And I think that we're already seeing some accumulation back over here in the market down near these lows. That's what prompted this last move here. I think we're seeing more accumulation over here. And I think the reality of the doom and gloomers is just unwarranted at the moment. I think the global markets are going to be transitioning into a new normal after this unwinding phase. The global markets have already unwound sufficiently, in my opinion, to attempt to move forward, but we need to see how it plays out over the next 6 months. All right, guys, that's it. Sorry for being a little long-winded.